Hi, this is Pete Birchler, StockMarketAlchemy.com, and today's Friday, February 28th, around midday in the U.S. markets here. It's been a little while since I did a video update on here, and just wanted to show some charts and go over some, particularly some longer-term type of information here, but throw a mix of some different time frames in. And this may not be in any particular order, but I want to go through some things here rather quickly. First being S&P 500 making a new high today. It made an attempted breakout here on Monday and reversed off that breakout, consolidated, and now is pushing to higher highs here. So markets at all-time highs tend to perform very well. There's no overhead resistance, and the trending activity in markets at all-time highs can be very high. So it may remain in relatively stable trends compared to historical norms. So don't think that this is necessarily overbought just because it's at an all-time high. What we really want to do is narrow in on more specific indicators given sentiment and shorter-term price movement in order to before we start to get bearish on any type of time frame. So we're going to look at some of those things and some chart formations as well. Now let's go through some weekly time frame data here. So this is the S&P 500 weekly chart showing a stochastics indicator, and there's Bollinger Bands up here. A couple things to note. There is currently a potential bearish divergence here as prices making a new high relative to the January-December highs, and we see the stochastics at lower highs here. And relatively similar to the look of the chart here in spring of 2011. And in terms of the stochastics and the price correction. And then also, if you look at the Bollinger Band formation, similarly back here we have an uptrending Bollinger Band formation which starts to peak and channel here as the market corrects. So the upper Bollinger Band starts to go sideways, and that's what we're seeing here. We see the upper Bollinger Band turn sideways here around New Year, and now it's channeling, and now we have price coming back up and touching the upper Bollinger Band with a divergence and Bollinger Band channel. Not real dissimilar to what we saw up here where we saw a reversal. So that's something to be aware of here, is anytime we're seeing technical divergence patterns on breakouts, we need to be a bit wary and prepared for the scenario in which case the market then stops and puts in an early price reversal. So our strategies need to be in place to protect longs, and then also, if one is looking to short, be prepared for the specific setups and indicator settings you're looking for to potentially make a short position. Moving to the MACD chart, we can see again MACD basically peaking here around the new year, falling as we saw the correction, and prices at a higher high, but the MACD has not even crossed back up yet. So if we see price roll over and move below this February low, then that could be potentially bearish price confirmation, given the indicators here. Be potentially leery of the markets over the intermediate to long term if that takes place. Now, from a pattern formation here, I want to delve into maybe some semi-objective type of analysis here, looking at the chart pattern. And one of the concepts I talk about at times on these videos, and also go into good detail for people who have subscribed to or signed up for my Trader's Crystal Ball e-course, I talk about price action at trend changes, and specifically concepts of overbalancing of price and time, which is a concept from W.D. Gann, and also talk about larger and faster price formations indicating new pattern development. And based off of the what I call the price logic and pattern development of this bull market here, I really view the movement up since the end of 2012 as being probably a distinct price movement in the pattern unto itself. And so if we look at the larger corrections over the last year or so, since late 2012, we see this decline from May to June, decline here from August 2013, and a decline here from New Year down into February. And that's what these three lines project here, is those three corrections. So if we were to see a high and then a price reversal, and we project these lines down, so the largest corrections in the midst of this uptrend since late 2012, that would be a logical indication that we would be seeing a larger downward market force than anything we've seen during this phase of the pattern development, and that may lead to a larger price correction, possibly something on the order of the major corrections we saw in 2010 and 11, which were about 17% and 21%, respectively, even in the context of continuing bull markets. And additionally, always the possibility at some point here that we will see, a bull market high and experiencing, a significant bear market environment. So those projections from those specific corrections you can place on your chart and understand that, let's say we get a reversal very soon here, which would be actually typical for a significant market high, is for price to just break out for a few days above a prior high and then reverse back below it. And if we saw that, and we saw the price correction get larger than these corrections, that would also be basically causing it to break the February support, and at that point we would with these other divergence patterns, the overbalancing of this last price formation and a break of the higher series of higher lows in the market would all be some indication that we could potentially see a larger downward correction take place. But until then, obviously the price trend is up, and we need to respect the price trend in the market. Now, moving to a longer term time frame, I'm going to show a couple charts. One is going to be the Nasdaq, and similar comments would apply for the S&P 500. Actually, maybe let's look at the S&P 500 here. If we look at the kind of upper channel line in the S&P 500 from the highs over the last year or so, so the highs in spring 2012 to the highs here in spring 2013, that channel line there would suggest that it's just overhead would be a kind of overhead resistance line. So if we see price push much higher here, we're going to be towards the upper end of that channel on that time frame. And if we look at the Nasdaq, we can see kind of a similar thing going the whole way back to 2010, the highs in April 2010, and then the highs here in April, May of 2011. If we draw a channel line between those 2 points, we can see prices now breaking that upper channel line. And that's a type of thing we often see as markets precede a significant high, is that they'll move up into this upper channel line, and then we can often see that happen on a shorter term time frame as well, something to the effect of, here's our shorter term channel line, and we see price moving up above that. So when we see price really extremely moving high above longer and shorter term channel lines, that can be, hate to use overuse the term blow off, but that can be a time where we're really seeing the market pushing to an extreme relative to its trend lines over a given period of time. So something to look for and just be aware of here is that on a longer term basis, this is a monthly chart on the Nasdaq Composite, we're seeing price get not too far from the year 2000 tech bubble highs, and we're seeing price touching this upper channel line of the bull market from 2009, and that would be just a potential overbought condition. Now, additionally, on an even longer term time frame, we're going to look at the Dow and look at a quarterly chart. So each one of these candlesticks here is 3 months of price action, and The Dow chart is showing a potential broadening top chart formation, and I'm going to put a link on the blog webpage where you can go to Bolkowski's website and read about the broadening top. Not a chart pattern that I would use for trading, but just for analysis purposes. Understand that there's this volatile kind of inverse instead of a contracting pattern. The contraction is going backwards in time, so we're going forward and having an expanding market environment where we're seeing higher, a rising upper trend line 1, 2, 3 points, and then a falling lower trend line 1, 2 points. And the implication here is, even on this quarterly basis, going back from the year 2000 to the 2007 bull market high, and now here to 2014, is that we're potentially hitting a long-term resistance line with anticipation that at some point here, it doesn't have to be today or this week, maybe the market continues to ride this upper trend line for a couple months, but we could see this market top here and at least partially retrace this last portion of this broadening formation. And the way Bolkowski suggests trading this pattern on a chart is, wait for that retracement, and then if it retraces and then breaks out, then you buy that breakout. Or if it comes down here, retraces and breaks lower again, then you could buy the bottom breakout. Now this is such a large scale chart pattern that I don't know that there's really much of any precedence of patterns of this size throughout history, so I would be not real quick to make presumptions about the significance of this and what it means, but nevertheless, these type of trend line or channel lines I have found to be significant in charts for at least anticipating we could see, could believe the market is kind of running hot here and may need to experience some type of correction, in which case looking at a quarterly chart, any type of correction we see on a quarterly chart has a potential to basically make that a bear market, even if it remains well above the 2009 lows. So just some things to be aware of on a longer term time frame. Now as far as where the market is over the short term, we'll look at some real money sentiment charts here. Look at the put call ratios and the VIX. So this is a chart of the 5-day put call total put to call ratio in pink, and one standard deviation bands of the 20-day average in blue. If you've taken my Trader's Crystal Ball e-course, which you can get for free, just using the form on my blog or my website, I teach you basically how to use this as a very simple yet very effective market timing tool. Currently what it's saying is it's basically neutral. The 5-day average is in the middle of the range, so there's no short-term extreme. What I want to point out is that with the S&P 500 here making higher highs and a higher high relative to the New Year's time frame, we would typically expect the normal relationship between the put-call ratios is we'd expect the put-call ratios to actually be making lower lows. So we'd expect at the current time frame in a stable market trend for this average to be at or lower than this average here, and it's not. It's substantially higher. So this is a type of non-confirmation or divergence pattern between the stock index prices and the underlying sentiment as evidenced by these put-call ratios. Those type of divergences are typically significant. So we'll have to just keep that in mind here as we watch this attempted breakout in stocks to get higher highs. And just understand that the sentiment backdrop is relatively typical for a possible failed breakout, but don't need to jump the gun. We should have some type of objective signal, both to take us out of long positions or possibly give us some type of a short setup. Now, in the last video I sent out to members of my email list, I had shown while price was basically up in these regions here, and even in the last blog post I made, that we probably have room for the average of the put-call ratio to fall prior to experiencing some type of high in a market. And we started to see that. If we were to see these indicator lines down here become more extreme, we could have some more confidence that we're probably nearing a more significant high and due for a correction. At the same time, however, we are seeing these divergences develop, so just something to have on the radar. Interpret what that means, and then your likely best course of action if the market is to either continue up or move down. So have those contingencies planned for any possible market movement to come. Moving to the VIX here, similar story to the put-call ratio. The last video I sent out to members of the email list, I talked about this volatile formation where the short-term volatility was out of balance with the long-term volatility, and indeed that proved to be significant. We've seen price rally basically ever since I sent out that information, suggesting we were going to see the market rally, and now we're not at a situation where we're seeing volatility at an extreme low relative to its range, but we are seeing again non-confirmations or divergences, in that here we see the VIX, which moves inversely correlated to stock prices, and since stocks are at a new high, we would typically expect the VIX to be at a lower low relative to its prior low points, and we're seeing it's at a substantially higher high than it was around the New Year's time frames and even the lower end of this range over the last couple years. Again, that is very typical at market highs, and I've said in past updates that there has been no significant high of a leg up during this entire bull market since 2009 without a VIX divergence. So that doesn't mean that every time you see a little VIX divergence there's going to be a major pullback, but certainly this is the setup that happens and precedes, has always preceded the significant corrections in the market over the last 5 years or so. So we're right on the right in the type of scenario where we could see something significant develop to the downside. Point being, for individual traders who you're responsible for managing your own risk, managing your own position, setting your own stops, just take this information as what I would suggest is to have protective stops in place, to be moving those protective stops up with the market. If you're really good, you may be able to get out right at highs, but more often than not, the market will kind of lull you to sleep and then surprise you with some rapid movement down off a high. So that would really suggest you need to have some type of way to keep locking in further profits, moving your stops up, so that when that move does happen in the market, you get taken out, and then you're either in cash. When you're on the sidelines, you're able to view the market very clearly. When you're still in positions, you can kind of be biased, seeing just what you want to see relative to the stocks or indexes you're in, and hope that they continue to move in your direction, and that creates somewhat of an analysis bias. Whereas if you can move those stops and just get taken out, and then you can just kind of look at the market from a fresh perspective and interpret it more accurately, and just patiently wait for the next very high probability signal that you see according to your method. So that's the really the analysis here on the put call on the VIX. Just briefly show here the McClellan oscillator. It peaked back here on February 14th, and it's at a lower high relative to a couple weeks ago, so another divergence in breadth. So this breakout, while it still could get stronger and we could see it make a higher high, we're seeing divergences in price, we're seeing divergences in sentiment, we're seeing divergences in breadth here, and those are just things to take the necessary precautions, but doesn't necessarily mean we have any confirming price action yet. Doesn't necessarily see we're that likely to see anything more than what ends up being a consolidation or normal correction in a bull market until proven otherwise. If there are any more specific questions about any portion of this analysis, please feel free to leave a comment on the blog or on YouTube, or email me at pete@stockmarketalchemy.com, and I can use whatever questions you pass along for future videos to get out to people who are watching these videos. So with that, I'll let you go. Have a great day. All the best to your trading.